Now, since we're talking about options, the next question goes into the structured dividend capture strategy that you are applying. From Krishna, he's wondering how much percentage of the portfolio appreciation actually come from SDC last year. And he can see that the approach as the bull and bear market is bull and bear market independent. Is this assessment correct? And as the AUM increases, do you see these strategies still being feasible?
Yes, this is very feasible. We can scale this into the hundreds of millions. In fact, if you look at the companies that we're applying this to, many of them are 100, 200, $300 billion firms. And so there's a huge market for these. This is also only a piece of our overall strategy. We have our existing infinite compounder portfolio. So if you imagine that we're running, say, 20% cash through this, our portfolio could be absolutely huge. We could have a $2 billion portfolio and still be executing our structured dividend capture on 20% of our internal portfolio. So we really can scale this strategy. There's nobody else doing this. The space is wide open. It's quite sad, actually, because we don't have the capital. We just watch this pile of gold expire every single month. We can't capture it all. So I encourage all of you to go out there and try and capture some of this. This strategy, based on our back testing, is evolving, okay? And we're not always putting the same amount of capital into the strategy. But if we were to apply the attribution last year, attribution would be about 30% coming from structured dividend capture, and the rest, the 70%, coming from the remaining portfolio. But let me tell you a little detail. When I showed this slide of our ownership. Our portfolio currently is a little under 24 million, but our ownership is like 24.5 million. Okay, so technically we have a little bit of our core infinite compounders on margin. All right, we have like $1 million in margin on a $20 million portfolio. We have about 5% in margin. So we are still executing structured dividend capture, but we're executing it more out of discipline. We've reduced the amount that we're putting into each of these opportunities, but as we raise more capital, we will definitely be putting that capital into the structured dividend capture opportunities. We have now, because we recognize things like selling the put in the money, and we recognize things like how quickly and how much of the time volatility decay over the last 21 days, we now have extended the duration on the puts, and we write them in the money, and we're drastically augmenting our expected results. We're almost doubling our expected results. And we thought we were being conservative previously selling out of the money puts, but as we analyzed through Monte Carlo simulations, we realized quite clearly that we're capturing everything that falls and nothing that is flat or going up a little bit. And so by simply selling an in the money put, we still capture all the ones that fall, but we capture a lot more that are flat and go up. And then we get those dividends and the premium for the call as well. So we are really improving the strategy all the time as we move along. I'm quite confident in these results. They're astonishing results, 24% annualized over 20 plus years. And we're running this algorithmically based on what we would do today. We're going all the way back 20 years and saying, run the software on the 13Fs, tell us the companies we'd buy, and tell us what would have happened. And what it told us is 24% annualized with a little bit of volatility. It's amazing. And so we will be executing this. What this also does is allows us to be incredibly patient. Imagine the value fund sitting there with 20% cash. That is a drag on performance. Everybody's competing. We're all trying to get the highest numbers, but we're trying to do it safely. And so value funds tend to hold cash so they can allocate it to the new opportunity coming in the future. They want to make sure they have that opportunity. We've now developed a way to hold some cash, but not have it be a drag on the fund. And we don't need to allocate that to a 10% opportunity annualized. We can be patient. We can wait for that 20, 25, 30% annualized opportunity because it's not going to be a drag on our portfolio. And so as we raise more money, we will absolutely keep investing in the structured dividend capture. Right now, the whole portfolio is the infinite compounders. That's not a terrible thing. Our infinite compounder portfolio is amazing. But as we raise capital, I think we're going to see our returns go up.
Regarding your strategy on SDC, have you ever encountered a situation where the stock was assigned in the put and subsequently the stock price actually fell below the cost basis, making it difficult to exit with a cover call above the cost basis?
Yes. So that happens. We're actually in our divergence analysis, we're trying to analyze how frequently this occurs in a given quarter, because if we can manage our expectations, it's not as alarming. We had this happen with Icon Enterprise. Icon Enterprise was paying a really high dividend, and it looked somewhat unsustainable. They were funding some of it with debt, et cetera. And it doesn't even need to be, by the way, to clarify the question, it doesn't need to be that it was assigned. It can be that we've just sold the put. So while we had sold the put, the shares declined from 30 to 20, under 20, it fell about 33%. And during that period, we were selling calls, but as the price declines, they don't get called away. And so what ultimately happened was the shares were selling for maybe 31, and we sold a put at the time, which was actually not what we would do today, but we sold it out of the money. So we sold a 30 strike put and picked up about $2. And then the shares started to fall. So as the shares were put to us, we were scheduled to get a dividend. They actually cut the dividend. So the dividend got cut in half. And we then just continued selling our calls. Week after week after week, we were selling calls as it declined. And ultimately, we picked up $2 for the put. We picked up another $4 in calls as it was declining. We ended up exiting for $20. So in the course of that entire fall from above 30 to below 20, which would have been a 30% decline or more if we were holding the stock, we exited and we had about a 10% decline. And keep in mind, we're doing this on a basket. So although I showed you this Gantt chart that says start with Chevron and then go to Johnson & Johnson, then go to Fox Corp, that's not what we're doing internally in its extreme. We are analyzing these 13 Fs, and Alpha One is providing with us with about 40 opportunities per quarter. So we turn that into a basket. We divide our capital by the 40 opportunities, and we allocate to each one. So in the case of Icon Enterprise, we were allocating 1% of portfolio capital. The stock fell 30%. We fell 10%, but it's totally insignificant because it's in a basket and other gains make up for the Icon Enterprise loss. And that's a pretty extreme loss. So when does structured dividend capture not work? During a flash crash, or something where everything goes down and stays down. We will get put that. We will have a slight margin of safety because the put premium will bring our net cost below what it was originally. And then as we sell calls, by the way, we'll see a VIX spike and volatility spike. The call premiums will spike, and we will then sell a call during heightened volatility and make up a lot of the declining stock price. But generally, what we want to avoid is the whole market declining. If the market just steadily declines, or if the market's flat and volatile, we will do very, very well with structured dividend capture. It's just the sudden declines when it goes down and stays down that we take a little bit of a hit.
It's how wonderful that you guys are using structured dividend capture to lower your risk, at the same time increase your return in the long run. The next question goes back once again on the SDC. Is the cash held to cash secured puts earnings treasury or market rates like around 5% now, or how does that work?
The cash, when it sits in IB, we're given just a little bit of interest. And IB is pretty competitive, both on their margin rates and on the interest that they pay. They're very competitive. So we can't do much better other than maybe going into treasuries and whatnot, but What we're really doing is we're running structured dividend capture on that cash. So if there's cash sitting there, it's earning a very small amount of interest, but we're redeploying that and trying to grab a dividend every week or two. So we're artificially creating more, it's cash generative for us. So the cash sitting around in most value funds sits there. But in our fund, we're actually allocating that and then pulling it back to cash, allocating and pulling it back to cash on a regular basis.
And following up on SDC, what's the tax rate applies to the dividends received?
In our long-term portfolio, we are super cash efficient. In fact, if we don't sell, it's all unrealized capital gains. And if we do sell, it'll be treated as long-term capital gains. In our structured dividend capture, because it's short-term, it is treated as income. It's all treated as income. We don't love that aspect of it, but it's a very high yield and it's available for us. So we're going to go pick up that cash. What happens, as everyone in the fund knows, you receive a K1 in March each year before March 15th. It's usually coming between March 1st and March 15th. Everybody asks me on March 1st, and Spicer's usually finishing it up. That K1 is then used for everyone's personal taxes. So if we had gains that were realized, it will be broken out into long-term versus short-term. And of course, if there's ever a tax liability that is burdensome, we don't encourage this, but you can always redeem. It's like if we've made 50% and then you have to pay some taxes, you don't have to be that upset about it. You can just redeem a little capital, pay your taxes, rather than, struggle to pay your taxes. So if we make money and have to pay taxes, that's an okay problem to have. We love it when we can compound without paying taxes as unrealized gains. Unfortunately, with short-term dividend capture, it's all treated as short-term and it's all treated as income, but that's okay. So we have a little bit of cash generative income within the fund. It's a nice engine behind the fund. And if anybody needs capital to pay some taxes, you can redeem a little bit and meet those liabilities.
All right, following up from Dylan regarding SDC on Southwest, he understands that in the past, Southwest is a stock that you've executed SDC on. Do you guys monitor stocks that you perform SDC on as potential holdings? And he knows that generally airline is a notorious industry. So what's your take on that?
It's a little different. I would not want to buy Southwest Airlines as a long-term compounder. However, when we're running things through structured dividend capture, we don't actually care if they grow. All we care is that they don't fail in the next month. We generally are looking at larger, stable companies. They pay a dividend. A lot of times they're larger cap firms. And because the more stable companies are the ones paying these dividends. So we could potentially run structured dividend capture on something that we end up owning for the long term. We absolutely could be doing that, but that's typically not what's going on. What happens is, and to give you a few metrics, when we do our 13F analysis, we're analyzing over 100 high quality value-based funds. All right. And those funds are usually concentrated and they're low turnover. So multi-billion-dollar asset manager makes a multi-$100 million investment into something that's of interest to us. And when they make that investment and everybody making their investment, we run this Alpha One software and it runs all the analysis and it gives us our divergence analysis and it shows us the superset of companies that are owned within these 13Fs. So if there are, say, 5,000 publicly traded companies available in the US that we might be looking through to buy, the superset of every company on all these portfolios is roughly 400. So we automatically eliminate 95% of the market, 90% of the market. And we're sitting there looking at a few key firms, hundreds of firms. But then further, when we start running our analysis on determining what we can run structured dividend capture on, we're still starting from that pool and ultimately pull out about 40 firms in a quarter. So we've narrowed this market down from 5,000 firms to 400 firms to 40 firms. So we're taking 40 firms every quarter and running structured dividend capture. And those firms are changing some are consistent, but some change every quarter. So obviously we have a 7 holding portfolio. So we are looking at these. We look at them more carefully than other firms, but the intention is not really to own them for the long term. We're just grabbing a few dividends. It's actually very much zero sum. So in terms of the long-term value investing, we don't look at that as zero sum. We're adding value to the firms. We're adding value to society. We're adding value to all of you. We're not taking value from somebody else just by owning the shares. But when we're engaging in structured dividend capture, unfortunately, that is just a zero sum transaction. Somebody else, we believe, has made a mistake. And so we're just selling that to them and collecting that money, and then we just flip it back to cash. So although we do evaluate them, these are really short-term holdings. We need to sort of be sure they're not going to have a major problem in a month, and we can't always be positive. We talked about Icon Enterprises, but for the most part, these are larger, stable, sometimes just blue chip companies, and we're just selling a put to get the dividend, selling a call, and getting back to cash. We're not looking for long-term ownership of the business.
Thanks for the detailed elaboration. The next question comes from Alan. He's asking, what's the percentage of time that you guys spend on SDC versus analyzing long-term stocks for holding?
Yeah, it's a great question. It's a little opportunistic. So, right now we're fully invested. And so we're always, it's just my passion. We're always looking around at new opportunities. We're always trying to find the next way that we can make a 10x return on something. So we always have our eyes open. There's a lot of different channels that we get it through. Sometimes it's through these 13Fs, and then we're always poking around looking. We get these 13F analysis, and now we have a whole prioritization. So we know the prioritization of the firms that we want to be looking at and analyzing. So we're constantly trying to look through them, maybe just getting a sense of things. We also, one of my favorite functionalities in Alpha One, just because it's so convenient, is we have a calendar generator that basically goes out, uses AI, goes out, it searches the web, it pulls up every company meeting. They announce them just a couple weeks before they happen. So it goes out and it finds all the meetings and it pulls all this quantitative data and it makes a meeting invitation. All I have to do is open it up and click on it, and it just plays in the background. We listen to earnings calls all day. We can just play them and keep working. We can work on structured dividend capture and have an earnings call playing in the background. So this is just a constant thing for us. I'm quite frequently attending a presenter at a variety of events, some of these value events, things that happen sometimes at Berkshire Hathaway, but also in Switzerland and Dubai. There's a community of us value investors that are constantly sharing ideas with each other. It's very difficult for one person to find every opportunity in the market. I would say more than half of our time is spent analyzing long-term companies, but the Alpha One process is aiding our efficiency in analysis. So because we're able to generate an analyst report in a day and review 20 pages, that jumps us ahead of someone else who's doing it manually over a week and a half. So we are constantly finding shortcuts, efficiencies, and ways that we can move through our process more quickly. But right now we're fully allocated. So until we raise capital, not only are we fully allocated, but we're fully allocated. We have some call options. We need to raise capital to buy the rest of our Google. We need to raise capital to buy the rest of our Baba, and we need to raise capital to execute our structured dividend capture. So we're constantly looking for new ideas. We actually have way more ideas than capital. We have way more that we can do. So we just keep going one foot ahead of the next.